In 2005, one man predicted the biggest financial collapse in modern history. He had never worked on Wall Street. He wasn't an economist. He was a doctor. But here's the part of the story almost nobody talks about. The part where being right nearly destroyed him anyway. Michael Burry is a hedge fund manager and a licensed physician. He earned his medical degree, then started a residency in neurology at Stanford. He never finished it. While he was still seeing patients, off-duty, at night, he was teaching himself to invest. That's the part that should stop you. A neurology resident, doing finance as a hobby, on the side, between shifts. By the late 1990s, Burry had already built a reputation as an investor, not on Wall Street, but on stock discussion message boards, where he'd been posting his analysis since 1996. He was still a neurology resident at Stanford. He was still juggling hospital shifts. But at night, under the pen name Value Doc, he was writing investment analysis for Microsoft's MSN Money. He ran a transparent stock portfolio called the VSN Fund, open for anyone to watch. Barron's featured that fund in October 1999, noting a 38.7% year-to-date gain, outperforming both the Dow and the NASDAQ. Nobody had asked him to do any of this. He just couldn't stop thinking about markets. Years later, in his mid-30s, Burry was diagnosed with Asperger's syndrome, prompted by his son's diagnosis and his own research into the condition. He said he believes it gave him an edge as an investor, more rational, less emotional, less swayed by the room. The trait that made him awkward in every other room in his life, the obsessive focus, the discomfort with social consensus, the inability to just go along with what everyone else was saying, turned out to be exactly the right wiring for what he was about to do. In late 2000, Burry shut down his website and launched his own hedge fund, Cyan Capital, funded by an inheritance and loans from his own family. His first outside investors were Joel Greenblatt of Gotham Capital and Jack Byrne of White Mountains Insurance Group. Between its launch in November 2000 and June 2008, Cyan Capital returned nearly 489%. Over the same stretch, the S&P 500 gained less than 3%. So by 2004 and 2005, this isn't some random guy guessing. He has a real track record. He just doesn't have the background anyone on Wall Street would recognize. Now here's where the story gets interesting and a little uncomfortable. By the mid-2000s, mortgage-backed securities had become the financial system's favorite product. Banks loved them. Ratings agencies blessed them. Regulators trusted them. The whole machine was built on the idea that housing prices would keep going up and that the loans bundled inside these bonds were basically solid. Those bonds were built on subprime mortgages, a lot of them teaser rate loans, meaning they started cheap and then reset to much higher payments a couple of years in. Nobody on Wall Street seemed particularly worried about that. The rating said AAA, the models said safe. And when everyone agrees something is safe, questioning it starts to feel a little embarrassing. Burry wasn't embarrassed. So when he turned his attention to the mortgage market, he did something almost no one else bothered to do. He actually read the loan documents, not the rating summaries, not the analyst reports, the underlying prospectuses, loan by loan. What he found didn't match the ratings at all. Borrowers with no income and barely any documentation were making up a growing share of these loans. He worked out that once the teaser rates expired, usually within about 2 years, a wave of defaults was coming. And when it hit, he believed the bonds built on top of those loans wouldn't just wobble, they'd collapse. Think about what that means for a second. The entire financial system, the banks, the agencies, the regulators, was operating off summary ratings. Burry went to the source material and found something completely different. The loans were far riskier than their official grades suggested, and the bonds built on top of those loans were, in his view, going to collapse. So what do you do with that information? At the time, there wasn't even a financial product that let you bet against these specific bonds. So Burry did something almost nobody had done before. He convinced major banks, including Goldman Sachs, to invent one for him: credit default swaps on subprime mortgage bonds. Essentially, insurance policies that would pay out if the loans underneath them defaulted. The banks were happy to sell him this insurance. They thought he was wrong. They thought they were collecting easy premiums from a guy who had clearly lost perspective. And for a while, it really looked that way. This is the part of the story most people skip over, and it's the most important part. Housing prices kept climbing. His fund kept bleeding premium payments. Over $1 billion committed to these swaps by late 2005, with nothing to show for it yet. And his investors, the people who had trusted him with their money, started to panic. They weren't just worried. Some of them were furious. They thought he had abandoned his strategy. They thought he had lost his mind. They threatened to pull their money, to sue, to force him to unwind the position. And here's the brutal part. He was right the entire time. He had done the work. He had read the documents. He knew what was in those loans. But the market didn't care yet, and that gap between being right and being vindicated nearly tore everything apart. There's a name for this in Greek mythology. Burry has nicknamed himself Cassandra on his own social media, after the Trojan priestess who could see the future perfectly, but was cursed so that no one would ever believe her. He picked that name himself. That tells you something. And if you watched our video on Rich Dad, Poor Dad, you'll remember the idea that having the right idea isn't the same as having the runway to survive it. Burry was living that lesson in real time. Except the stakes were hundreds of millions of dollars and years of his life. Then 2007 arrived. Defaults started climbing. Exactly as Burry had predicted, the teaser rate loans began resetting to their higher rates, and borrowers started missing payments. Other investors, people like Steve Eisman and the team at Cornwall Capital, had independently found the same thing Burry had found. The impossible scenario was becoming real, and the financial system that had laughed at these bets started to crack. When it was over, Burry had made roughly $100 million for himself, and more than $700 million for the investors who'd stayed with him. The trade that everyone thought was insane turned out to be one of the most profitable in Wall Street history, made by a doctor who had taught himself investing as a side project between hospital shifts. But here's what the numbers don't show you. In 2008, right after that financial win and the investor revolt that came with it, Burry shut down Cyan Capital. He won. And then he walked away. The years of being called wrong, the client revolt, the isolation of holding a position completely alone while the people around you insist you've lost your mind. That doesn't just disappear because the trade paid off. A couple of years later, in a New York Times op-ed, Burry made a pointed argument. Anyone who'd studied the markets carefully in 2003, 2004, and 2005 could have seen the risk building in subprime. He put the blame on regulators for ignoring warnings that came from outside their usual circle of advisors. He wasn't bitter about being doubted. He was frustrated that the system was designed to ignore the people doing the actual work. So, what's the real lesson here? The surface version of this story is, guy sees something nobody else sees, bets big, wins big. That's the movie version. The actual lesson is more specific and more useful. Burry operated with an extreme sense of independence. He tuned out consensus almost entirely, and his method was never complicated. It was relentless, unglamorous research, filings, balance sheets, footnotes, the stuff everyone else skips. He didn't have a contrarian opinion. He had a contrarian conclusion that came from doing work nobody else was willing to do. That's a real difference. Having a different opinion is easy. Anybody can say the market is wrong. Burry sat down and read hundreds of mortgage prospectuses until he could prove it. And then, this is the part that's genuinely hard. He built a position that could survive being right too early. He had enough financial structure, enough conviction in his own research, and enough stubbornness to hold that position through 2 years of everyone around him saying he was wrong. Contrarian thinking, real contrarian thinking, isn't a personality trait. It's a process. It's doing the deep, unglamorous work that everyone else skips, and then having the structure to hold your ground when the pressure to quit becomes almost unbearable. If this kind of story is what you're here for, there's more where this came from. Drop a comment below with who you want covered next, and subscribe so you don't miss it when we post. Because Burry's story is about a man who bet against the system. He spotted what everyone else missed and had the conviction to hold that position even when it nearly broke him. But conviction doesn't only show up as betting against something. Sometimes it looks like betting everything on yourself, with no system to short and no one else's mistake to profit from. Just a product nobody believed in yet. That's the next story. A founder who went broke twice before the age of 30, refusing to quit on an idea everyone told him wouldn't work. That company became Nike. That's next.